So, you're changing jobs, or maybe you're getting ready to retire. You're probably about to move the largest single sum of money you've ever handled in your life. But here's the thing, there's a hidden danger in how you do it. Just one wrong check in a box on a form can spring an immediate and, frankly, painful tax trap. Today, we are going to break down exactly how you can protect your life savings from this very common, very costly mistake.
And what is that trap? It's this. The IRS can and will immediately seize 20% of your retirement money. Now, this isn't some penalty you can argue about later. It's a mandatory withholding that's literally written into federal law. One simple mistake, and boom, a fifth of your nest egg is gone, forcing you to scramble to come up with that cash on your own to avoid even worse penalties down the road.
So, to make absolutely sure this never happens to you, we're going to follow a really clear roadmap. First, we'll see why getting a check in the mail can actually be a trap. Then we'll dig into that mandatory 20% withholding. After that, we'll talk about the unforgiving 60-day clock, uncover a sneaky little limit called the Bobrow Rule, and finally I'll show you the single safest way to move your money, period.
Alright, so when it's time to move your 401k, you've basically got two paths you can take. One is completely safe and simple. The other, well, it's filled with risks that can cost you a fortune. And it all comes down to one simple question. Who is the check made out to?
The safe path is what's called a direct rollover, or a trustee-to-trustee transfer. The money goes straight from your old plan to your new one. You never have constructive receipt of the funds, which is just the IRS's fancy way of saying you never personally get your hands on the money. But if you choose an indirect rollover, that check is made out directly to you. And the second you have control of that money, a whole series of tax tripwires are immediately activated.
And that indirect rollover check? It triggers the biggest and most unwelcome surprise of all. You see, under Internal Revenue Code Section 3405C, your former employer is required by law to withhold 20% of your money and send it straight to the IRS. They don't have a choice.
Let's put some real numbers to this to see just how damaging it can be. Let's imagine you're rolling over a $500,000 401k, a lifetime of hard work and savings.
So out of that $500,000, before you even see a dime, your old plan administrator has to cut a check for $100,000, that's your 20%, and mail it directly to the IRS. That means the check you get in the mail is only for $400,000. You are instantly short $100,000.
And this is where the real panic sets in. Because to complete the rollover and avoid a massive tax bill, you have to deposit the full $500,000 into your new IRA. But you only have a check for $400,000. So where does that missing $100,000 come from? It has to come out of your own pocket, from your personal savings. You're basically being forced to give the government a giant interest-free loan until you file your taxes next year and hopefully get it back.
And what if you can't come up with that cash to bridge the gap? The consequences are pretty severe. That $100,000 shortfall is immediately treated as a taxable withdrawal. You'll owe regular income tax on it, and if you happen to be under 59.5, you get slapped with an extra 10% penalty. Worst of all, that money is now permanently kicked out of your retirement account, losing decades of potential tax-deferred growth.
As if being short $100,000 wasn't stressful enough, you're not just fighting a cash shortage, you're also fighting the clock. On top of that 20% withholding, you're up against a brutal and totally unforgiving deadline.
The second that check is in your hands, a 60-day clock starts ticking. You have exactly 60 days to get the full rollover amount deposited into the new account, not 61. And weekends, holidays, yep, they all count against you. If you miss this deadline by even a single day, the entire amount, the whole $500,000 in our example, becomes taxable income for that year. It's a disaster.
Okay, so there's the money trap, the time trap, and believe it or not, there's another one. This one is especially sneaky if you're moving money between your IRAs. It's known as the Bobrow Rule, and it's named after a big tax court case that set the precedent.
The IRS rule is crystal clear. You get to do only one of these indirect IRA-to-IRA rollovers every 12 months. And the key thing to know is that this rule applies to you, the person, not to each of your accounts. It doesn't matter if you have 5 different IRAs. Traditional, Roth, SEP, you name it. The IRS lumps them all together and treats them as one for this rule.
Now, it's absolutely critical to understand what this rule doesn't apply to, because this is where your safety is. It does not affect those safe, trustee-to-trustee direct transfers we talked about. It also doesn't apply to Roth conversions or, and this is important, that initial rollover from a company 401k into an IRA. This rule is specifically for when you move money between your existing IRAs using that risky indirect method. Okay, we've walked through the entire minefield. It's pretty scary stuff. Now, let's talk about the clear, safe path out, and, just as important, how to fix things if you've already made a mistake.
Look, the absolute best strategy here is prevention. Just avoid the mess entirely. Always, and I mean always, choose a direct rollover. It neatly sidesteps every single trap we've talked about today. There's no 20% withholding, no 60-day clock breathing down your neck, and no Bobrow Rule to worry about. It is, without a doubt, the foolproof method.
So, how do you make sure you're doing it the right way? It all comes down to one little line on the check, the pay to the order of line. If that check is made out to you personally, that's a huge danger sign. If it's made out to your new financial institution for the benefit of, you'll see FBO. You are on the safe path. You have to be explicit with your plan administrator about this. Okay, but what if you're watching this and your stomach just dropped because you've already missed that 60-day deadline? First, take a deep breath. There is a fix. Thanks to something called IRS Revenue Procedure 2020-46, you can use what's called a self-certification to fix the mistake without having to beg the IRS for mercy. The IRS actually provides a list of valid reasons for missing the deadline because they know that, well, life happens. And these aren't flimsy excuses. We're talking about serious events. Things like an error made by the bank, a serious illness hitting you or a family member, a mistake by the post office, or even just misplacing the uncashed check are all legitimate reasons you can use to certify a late rollover.
And the process itself is pretty straightforward. First, you're going to write a letter to your new financial institution. You can use the model letter the IRS provides, stating which valid reason caused the delay. Then, you have to deposit the funds as soon as you possibly can, which usually means within 30 days of the problem being solved. And finally, keep a copy of that letter for your tax files. That's your proof in case the IRS ever comes knocking.
So let's lock this all in. What do you absolutely have to remember? Number one, always, always, always insist on a direct trustee-to-trustee rollover. It's the only guaranteed safe harbor. Two, a check made out to you personally is a red flag. It triggers that automatic 20% tax hit and starts that brutal 60-day clock. Three, remember the once-a-year limit for indirect IRA-to-IRA moves. And finally, if a mistake does happen, know that the self-certification procedure is your lifeline, so use it immediately.
This all really leads to a final thought. The financial system can be incredibly complex, and it's full of these tripwires that can really hurt people who are just trying to do the right thing with their money. So the real question isn't just about following the rules. It's about recognizing that at the end of the day, you are the ultimate guardian of your own retirement savings. The real question is, are you prepared to navigate the traps?